Good evening, ladies and gentlemen. I'm your host, Seth Julian, welcoming you to today's session. Please let me know, because I've changed some audio equipment, whether you can hear my voice and see the opening screen. And you can please do that in the question and answer area. Just post whether you see, just post something to let me know. Perfect, says Kevin. Great, that's great. Good morning, afternoon, Jay. Yes, we can hear. Pucharura says, thank you. Okay, that's great. That's a great crowd. That's enough. We have a pretty good sized crowd in the room today. So let's just get down to business. I do caution you, though. Well, I'll caution you. It's anything. Let me introduce myself. I'm getting ahead of myself here. My name is Seth Julian, and I'm the Chief Strategist here at Alvexo. And I'm 65 years old. I've been trading for 52 years now in the capital markets. I started as a young man with a few shares of Xerox stock, and started my career, my professional career at Bankers Trust on Wall Street in New York City. Excuse me, in the early 1980s, and I've had positions with 3 other international brokerages, the last and current of which is Alvexo. I do have one protocol in the room that I ask you to adhere to, and it's simple, just that you please post questions in the question and answer area when you have them, because it just adds more to the dialogue effect and less to the monologue effect. But I do, and this is what I wanted to caution you about. I'm only using one screen today for communications complications, so I have to click in and click out of the questions. I don't see it in real time on one of the other screens, but I'll just check in every so now and then. So, divergence, volume, volatility, momentum. What on earth are we talking about? Let's just get a few technical things out of the way. The content is considered, this content of this session is considered to be market commentary and not, and shouldn't be perceived as independent investment advice or research. That's given to you by a broker. She knows your risk profile. She knows your capital asset level. She knows your deployment methodology, and she's in a position to give you guidance and advice and assistance. We're more like these two people, just sharing a common experience, looking at something, trying to understand it. The other thing I want to point out is that we offer derivative instruments based on, that means derived from the underlying asset, be it a stock or commodity or currency pair, and not the actual asset, though we do sell the actual stocks as well. But for those of you who aren't trading stocks and trading the contract for difference, the CFD, these are derivative assets. And that means they're derived from, they're based on the underlying asset. The price is always nearly exactly, they're all nearly exactly identical around the world. And but they're much more flexible, they're much cheaper, they're much more efficient, they're much safer. There's a lot of advantages. Most of the world's capital asset trading takes place in derivatives and not the actual underlying. But I do make that that fact aware to you. Now let's get down to business. Let me just say it's a longish session. It's 22 slides tonight, and it's not. They have graphs on them, but it's not what I would call a fun and exciting, interesting affair. But it's the truth about technical trading, particularly in the subject of divergence and volume and momentum, all of which are important. All right, so it's the kind of thing that you might want to take notes about. By the way, let me just check that it is being recorded before I get carried away. Yeah, it's being recorded. So it'll be, this session will be available to you in an hour or so after the session ends. All of you will get a link to the recorded session. You can review it if you like. What's divergence? Divergence is when the price of an asset is moving in the opposite direction of a technical indicator. So, excuse me. Pardon me one moment. Such as an oscillator, and we use an oscillator in our graphs. Those of you, the clients in the house who get our regular signals, among other products, are aware that we use the force index indicator developed by Dr. Alexander Elder, which is an oscillator, and that just means it revolves around, it oscillates, a fancy word for revolving, around a center line. It goes above and goes below and above and below a center line. It's called an oscillator. So when the price is moving contrary to the indicator, the technical indicator, All right, that's an interesting phenomenon. Why? Because just to digress for a moment on the subject of technical indicators writ large, all technical indicators, I shouldn't say all anymore, the world is so enormous, but the vast majority of technical indicators are based on the 4 or 5 outputs of all capital markets. The price at the opening of a time interval, the high price reached during the time interval, the low price reached during the time interval. Let me see if I can get you a chart to show you what I'm talking about. To stare at this dopey screen. I must have a chart in one of these. Here we go. But I want to show you one with volume. Huh. Maybe I don't even have one with volume. What do you know? Well, I'm just giving you a chance to. It's not. This is not a. Well, maybe this is. Maybe this could be taken for volume, but sorry, ladies and gentlemen. Let me just show you a regular chart. Okay. The high price reached during the interval, the low price reached during the interval, and the price at the close of the interval. And the interval can be anywhere, depending on your charting software, from 1 second to 1 month, or 1 year, or whatever you want. Now, the point is, and there's oftentimes a corresponding volume level associated with each time interval. Again, furthermore, those of you who are familiar with my charts, and let me show you, instead of just blathering on about my charts, let me show you a chart. Give me 1 second, please, ladies and gentlemen, because I'm working on this one screen. It's a little bit, few extra steps. I don't have multiple screens to make it efficient. But let me see this. Here we go. Well, here's typical. This is a typical kind of chart that we use here in the shop. Here's the Elder Force Index. This line here. Here's you don't see volume for some reason. Why not? Because it's too small. I see it's just too small. Yeah. You can get a better beat on the volume here. Yeah, maybe. Not much. It's low volume. What should be different? Yeah, Qualcomm has more higher volume. Okay, so this is volume on time. In other words, we had a high peak of volume at this moment, and you saw price was at its height there. That moment in time, it's a 1 hour chart. That was a lot of volume that traded there. And most of it, the majority, more than 50% of it was buy orders, and yet the price turned. That is a class. Well, that's not a divergence. That's just a correlation of volume. But you'll see if I make the elder bigger, you should see a big dip at that moment. It's a little hard to see, but it's worth just fooling around with this for a minute, because this is really what you need to see to understand what I'm going to be talking about with these. I'm sorry I'm so clumsy today, ladies and gentlemen. Okay, now if I make this, no, that's I went with this. Not auto fit. Huh. I don't know why I can't. What I'm trying to do is make this bigger. All right, I'm done fooling with it. We'll see later on the shows. Anyway, this is volume on price. In other words, it shows me in this data set, which goes back to September of 2022 until the present, all of the volume that took place at all of the price in this data set is visible on this graph here. And it shows you that this price, which we're nearly at right now, is what's called the point of control. It's the mean. It's the mean volume of this data set, and this is the price at which that mean falls, 120. So that's the idea of correlating the volume and the price. But the idea is open, high, low, close, and volume are the 5 data points that any market puts out. And all technical indicators are comprised of some combination or permutation or conflab, or whatever, some manipulation of those 5 data. So, divergence warns that the current price trend may be weakening. In some cases may lead to the price changing direction, a reversal. There is positive and negative divergence. This is a minor detail. I don't want you to get confused or hung up with this. Positive divergence means that a move higher in the price is possible. Negative divergence signals that a move lower in the asset is possible. See, it's not so helpful. Divergence is the key. Negative just means it's likely to diverge lower, positive likely to diverge higher. Divergence can occur between the price of an asset and almost any technical or fundamental indicator or data. How's that for inclusive? The concept simply means it's going against expectation. Price was going up, more volume occurred, and yet price reversed. And it was the sound effect. This is the warning sound effect. Take warning. Something is switching. And I just want to digress a bit and take a step slightly further back to remind you that the prevailing mentality, the prevailing psychology in capital markets is the herding mentality. And that simply means that we follow. There's a follow on. Thank you, Chase. Sorry, I just saw your comment now about the charts. I'm not seeing it anymore, but thank you. Thank you for your help anyway. The prevailing psychology in these markets is that we watch each other and watch the signals generated by the market and follow on and do as those signals would indicate. Most of the time, not all the time. Markets don't trend constantly, but they trend a significant amount of the time, up or down. But that trending is how we make a living. It's how we stay alive. Think of the image of a large herd of livestock on the hoof. They're moving. They seem to stick together. They stay tight. Only a very limited number of them can actually see what's out there in terms of predation or danger topographically, or even objectives like a watering hole or some shade or a sleeping or whatever. The rest of them have to follow signals from the fat ass in front of them. He moves this way, I move that way. He moves this way, I do that. Or to give you even a more exquisite example, if you will, a school of fish, giant school of fish, and they move in a mathematical, what's the word I'm looking for? Well, it's just coordinated in a way that's it's almost magic, because they know how to read signals. They know how to follow. The herding instinct. It's what keeps them alive. If somebody's not paying attention and moves the wrong way from those signals and diverges, that's exactly the word. Diverges from the rest of the school. If it's fish, you prey. You're done. You're eaten alive. And it's a bit vivid, dramatic, but that's what happens to our trading account. It can disappear. It can be just absolutely eaten alive by a market that doesn't have any doesn't give two thoughts about doing that to a trader. It's a zero-sum game. Remember, anything I may take out of this market is the expense of somebody else. And then whatever I put into the market is somebody else benefits from. Though divergence is typically used by technical traders when the price is moving in the opposite direction of a technical indicator. That's all divergence. That's probably its most widely used application. But I want to, well, I'll get to it. Positive divergence signals price could start moving higher. Occurs when price is moving lower, but a technical indicator is moving higher or showing bullish signals. That's a positive divergence. And of course, the negative one is when price is moving higher, but there's a technical indicator that's showing that a bearish signal, a negative. Don't get hung up negative bottom. It's the divergence we're talking about. Now here, it's in bold, it's in orange letters and highlighted, and so this is really important because I don't usually do this. Divergence is not to be relied on exclusively, as is any technical indicator. The fundamentals are what drive your interest in the trade, and the technicals drive your targeting of entries and exits. When you get in, when do you think it's a good time to get out with some profit? When do you think is enough with a loss? Those points, those price points can be not necessarily always are, but can be more finely and successfully tuned using technical indicators. But we are trend followers here in the house, and therefore we look for a trend, understand its fundamentals, and then use technicals to judge our stop losses, be it take profit or stop loss. There are traders who maintain, I've never met any of them, but there are traders who maintain that they can trade anything just on the technicals. Good luck to them. I don't know anything. Divergence is not present. In other words, my point is you need to combine both of them. You need to combine the fundamental and the technical. The fundamental alone, without taking a look at the technicals, is kind of like shooting in the dark. Divergence is not present for all major price reversals. It's only present on some price reversals. In other words, just because it's a reversal doesn't mean it was preceded by some sort of divergent signal that indicated it was coming. No, sometimes, not all the time. And that percentage, I've never researched. I have no idea what it is. My guess, just from not even a back of the envelope calculation, but a gut feeling, is somewhere around 30%, probably a quarter to 30% of reversals, or even corrections, are signaled by divergences. Not much more. I would even go with the low, maybe 20 to 25%. It's not that often. It's infrequent. Although I hasten to point out, I don't look for them. Sometimes when they jump off the chart and I see them and can't but notice them, that's my shooting from the hip statistic. So there may be many more that I don't notice. I confess that freely. What does divergence tell us? Divergence technical analysis may signal a major positive or negative price move. That's a useful thing, right? May signal a major positive or negative price move. Okay, I'm sick of this positive, negative business. Traders use divergence to assess the underlying momentum in the price of an asset. Momentum is sentiment. It's not as slippery as the words themselves would suggest. In fact, trade or chart analysis lifts the concept of momentum from physics, what is momentum? Speed, acceleration times mass. I think I probably right, something like that. The point is, it's an indicator of forward movement, rate of speed. In fact, it's a second derivative, if I'm not mistaken. Anyway, no, I'm not. It's not. It's a basic calculation, which is whatever it is, momentum. We substitute the word sentiment for momentum. That means there's a lot of volume behind a big price move. That tells you there's a lot of sentiment behind it. And now you can see that means there's a lot of momentum in the directionality of that move. A lot of people were behind it. If it went up, a lot of people were buying, and vice versa on the downside. However, when there's a lot of volume and price doesn't move that much, even if it's predominantly selling or buying, that indicates there was a big battle. There was a big battle, and neither side could really push the price very far. That's an indicator already of something. Of what, I don't know. But there's certainly likely to be a breather to be taken. All those traders that were in there buying and selling for nothing, for no profit at all, are likely going to stay away for a while until they see some more movement. In which case, price could by virtue of centrifugal force, just keep moving in the same direction on much, much lower volume, indicating nothing at all. Whereas sometimes you could see a great deal of volume in a long trend, and the price goes down, and the price weakens. Even though there was a lot of volume, the price reverses. That means there were way more people selling than buying, and the price is very likely to at least continue for the near term, short term, Yeah, one small detail I'd like to point out about technical analysis, and I didn't mean to sound a few minutes ago like I'm an anti-technical analyst. By no means. I'm a visually oriented chart follower. I'm a pattern recognizer. I mean, I do this for a living. Only to say that, excuse me, they're highly conditional. They're highly conditional. You have to be aware of that. And I'll just rest it at that. Traders use divergence to assess the underlying momentum in the price of an asset and for assessing the likelihood of a price reversal. Again, if you've got these big signals where a lot of volume took place and the price fell, or in the case of an uptrend, or rose in the case of a downtrend, it's likely, it's particularly the volume was high, that trend is going to continue. Whereas the case I made formerly, where a great deal of volume takes place with very little price movement, that's a signal that you're not going to get any more signals for a while until something changes. That's valuable information, but it's hard to judge directionality. And that's what we do as trend followers. We look for directionality. That's how we take money out of the markets. We find a trend, we understand it, we build the faith in it, we hook our little train to the engine, it takes us up and deposits a few coins in our profit column, and we get the hell out. We should do it again. And if the price reverses, we sell short. And whatever it is, we're in and out quickly. That's what we do as speculators. That's why those stop losses are so important. We stay too long, we're going to get crushed. We don't want to get crushed. For example, investors can plot oscillators like the relative strength index, the RSI, that's a common one, on a price chart. If the stock is rising and making new highs, ideally the RSI is reaching new highs as well. If the stock is making new highs, but the RSI starts making lower highs, and I'll point this out again, it may be a little confusing, means it's still going up, but the high points are lower than they were before. Still going up, the trend is still up, but with less oomph, with less momentum, with less sentiment. This warns the price uptrend may be weakening. Should be fairly obvious, but let me know if it isn't. I'll take some questions when I finish this page. This is negative divergence. The trader can then determine if they want to exit the position if you're long, or set a stop loss in case the price starts to decline. In other words, if you're willing to give it a little bit, say it might be the end, you're willing to reverse it, but a loss of a reversal of a certain amount will confirm to you, at least in terms of your position, it's time to get it. Positive divergence is the opposite situation. Imagine the price of a stock making new lows, while the RSI starts to make higher lows. Still going down, but less so. And that lower lows is a layman's way of saying the second derivative in calculus. Its rate of acceleration is declining. It's lower momentum. And investors may conclude that the lower lows in the stock price are losing their downward momentum. There you go. And a trend reversal may soon follow. Take a quick look for some questions. Does using divergence technical indicators work equally well in all time frames or only 1 hour or higher, Jay says. Oh, Jay, thank you very much. I meant to make that point, but neglected it. Jay says, in parentheses, for day trader. Absolutely. That's one of the magical things, if not, I wouldn't say the most, but one of the really, really terrific advantages of technical trading is it's universal. And I think I started to say you can chart in 1 second up to whatever you want. Charts are flexible. And I'm so grateful to making this point, because the most important technical indicator we have, and I wouldn't even call it a technical indicator, I would call it a tool, a technical tool, is that resolution possibility when we look at charts. We can zoom into 1 minute charts, 15-minute charts, an hour, 4-hour charts, a day, 2 days, a week, a month, and that ability to take in much, much larger data sets with less detail, what I would call the wide angle lens in terms of using the optic metaphor, and drilling down, and i.e. taking a much longer focal length, magnifying, high resolution, if you will, to a very small amount of data, but very fine detail. Every 15 minutes is a bar, every 1 minute. Those of you who tune into the live trading event on the NFP know that we use 1 minute charts, the only time I ever do, right after the release of the report, to take the most accurate pulse reading. That ability to zoom in and zoom out is your most powerful tool. For the simple reason that it gives you confirmation. The trend you're looking at is up, and you did your homework, you think it's justified, et cetera, and Jay points out, he mentions the day trader. So he looks at an hour chart, a 15-minute chart. The trend is clearly up. And then he looks from the 15-minute chart, he falls back to the hour, trend is still up. From the hour, he falls back to 4 hours, trend is still up. That is, in our opinion, in the opinion of Dr. Alexander Elder, who formulated who put into writing. By the way, I recommend Dr. Elder as a great place for starting traders as well as advanced traders. It's very, very useful information and very well written. He says that he referred to that method as the triple screen method, and he just gave it a name. Traders been using it forever, but the idea is if you have the same trend in different time within 3 different versions of conceivable time frames that you're going to hold that trade, that's nice confirmation. Is it ironclad? No. Is there any ironclad? No. Okay. That's what risk is, by the way, ladies and gentlemen. And I'm going to have to pick up the pace because we're really not moving fast enough. Sorry for this, but I know later on this what I can skip. We don't have to go into all the latest slides. Let me just check. Okay. So yeah, once you zoom in, all of your indicators, whether the moving averages, all hold. Now, the 20 interval moving average, if you were on a daily chart and you move down to an hourly chart, just means 20 hours. But it's the same. You don't have to touch a thing. All you change is that resolution, focal length, and all of your technical analysis is as valid in the short time frame as the long time frame. The fundamental analysis is much, much more subject to, to the movement of time. Oh, pardon me. Say in the case of agriculturals, droughts don't last forever. Chilling sub-zero temperatures don't last forever in the Arabica regions of Brazil. In the citrus regions of Florida, it may come, but they don't last. So the absence of time does, many things. But I think I made my point. Positive. Okay, enough with this positive negative divergence business. Any questions, ladies and gentlemen? Sorry for this slow pace here. Should the entry exit on spotting and divergence be based on price action confirmation, says JD? That's a good question. It's hard to answer, sir. Should the entry or exit on spotting and divergence be based on price action confirmation? Well, the short answer, of course, is yes, absolutely. Question is, it's too vague an answer. The question is how much price action? Yeah, of course, price action just means if the price moves against what your position and you get a divergent signal, at what point do you get enough divergent signal that you diverge the hell out of the position and close it? And I believe that's really what you're driving at, sir, and I can't answer it. I don't know. It's too sensitive to each particular trade. It's too sensitive to my trading record that day, that week, that month. If I'm a loss, it's just too much to say. Too many variables. What I'm trying to say. It's very subjective. And by the way, JD, I don't mean to be dodging your questions. It's an excellent question. This is simply not the forum for it. We run seminars all the time. Last November, we devoted all 4 webinars of the month to different aspects of risk and money management and doing all those calculations. But this is not the place. But it was an excellent question. I hope I made some effort to answer. I made an effort, but there went some distance to answer. Okay, let's continue. We got to pick up the pace. The difference between divergence and confirmation. Divergence is when the price and indicators are telling the trader different things. We discussed this now. Confirmation is when the indicator and price, or multiple indicators, are telling the traders the same thing. Okay, they're opposite. Ideally, traders want confirmation to enter trades and while in trades. the price is moving up, they want their indicators to signal that the price is likely to continue moving up. The limitations of using divergence. As is true with all forms of technical analysis, investors should use a combination of indicators and analysis techniques to confirm a trend reversal before acting on divergence alone. Okay, so to get back to Jaydeep's point, the divergence might be a useful smoke signal. It might just be plain smoke. You need to you can't act just on that signal alone. So it goes back to Jaydeep's question, and now the more I talk about it, the more I realize the answer is not a simple yes. It's really a definitive yes. Of course, you wait for price actions. I'm sorry, I didn't really fully grasp your question, sir. But yeah, the answer is yes. Wait for price action to confirm. But again, as I mentioned, the question is how much price action, how much. But that's a personal thing. How much? Where did you set your stops? Divergence will not be present for all price reversals. Therefore, some other form of risk control or analysis needs to be used in conjunction with divergence. Other technical indicators which determine where you put your stops is what that refers to. When divergence does occur, it doesn't mean the price will reverse or that a reversal will occur soon. Let me read that again. It doesn't mean when we see some sort of divergence anything at all. Divergences can last a long time. In other words, the things can be dissonant, which is, I believe, the term for extended divergence, for a long time. So acting on it alone could mean substantial loss if the price doesn't react as expected. Which is not a reliable tool. Now, this is about force index, and I do want to talk about this because this is a classic. This measures, and I'm not going to go into all of these. Way too detailed here, but suffice it to say, I'll give you a standing on one leg version of the force thing. Let me just go to the flow for questions. Take a break here for a moment. Whoop. Sorry, ladies and gentlemen. Where are the questions? Did I close that out? Sorry, I did close it out. Oh, here we go. Okay. Okay. All right. No questions. So, let me just say the standing on one leg version, the quick and dirty. What do they call it now? They say the skinny. On the force index is like this. Elder devised an indicator that really is one of the best indicators for divergence that I've ever come across. He combines the amount of movement between the open and the close of an interval. How much did it move? And the amount of volume behind that movement. And he then produces a histogram of per interval, which oscillates, revolves around a zero line. Positive means that the momentum is up, and we would assume, as we've discussed, that the price would be going up as well. And likewise for the downtrend, and of course the divergence, as we have spoken. Price is going up, yet the force index is tipping down, a negative divergence, if you will. So I'm not going to go through all of this. There's no need for it. You can look up. I don't know why I got so carried away with this. This is the formula. There's really no need for this at all. Yeah, let me just, this is worth reading. A one-period force index is comparing the current price. That's, in other words, that histogram entry under the time interval compares the price of that time interval to a prior price, and then multiplies that by the volume over that period between the two. The value can be positive or negative, hence the oscillation around the zero line. Typically, the force index is averaged over several periods, such as 13 or 100 minus a 23 or something, I don't remember, 32, I forget. Therefore, the force index tells whether the price has made more progress upward or downward, and also how much volume or power is behind the move. It's a very, very comprehensive. It's a very comprehensive indicator. A high force index reading is associated with very strong price moves and very high volume. Large price moves that lack volume will result in a force index that is not as high or even low compared to if the volume is large. After all, it's part of the calculation. As I mentioned, it's the difference between the open and the close multiplied by the amount of volume between in a certain moving average of intervals. Large price moves that lack volume result in a force index that is not as high. Because the force index helps to gauge market power, a force can be used to help confirm trends in breakouts, reversal. Well, now, a breakout is not a reversal. A breakout means that the price is bound above or below, having a resistance which is above, think of a ceiling, and a floor which is support below, floor support. If it is bouncing around those lines and can't penetrate either way, and then it does, and then it just really is moving in a sideways movement, a breakout will penetrate those barriers and usually head on, but not necessarily. But it does help indicate the arrival of a breakout. During strong declines in price, the force index should fall. During bear market rallies or sideways corrections, the force index will level off or move up because the volume and the size of price moves typically taper off. So it has even without a serious volume element, the indicator has less validity or value to us. We'll forget out. We just talked about breakouts, limitations of. Here's the RSI divergence. Now take a look. Price is falling, but the RSI is moving up. Lower lows, the classic. That's the definition of a downtrend. Lower lows and lower highs. But this has got the definition of an uptrend. Higher highs and higher lows. Now the higher highs rule is only, well, at this point of course it does, but here it doesn't even hold zero. This is lower. That is a higher high. I take it back. And this, all right, I take it. It's higher lows and higher. So RSI is clearly in an uptrend. Price is clearly in a downtrend. That is a positive divergence. Now, of course, the question becomes, when you're right here on the graph, not over here, a dope could tell you what to do. Now, when you're here, you see the divergence, even at this long point. Price continues to decline long after you identify the positive divergence. Do you buy? Do you buy here? Do you buy here? Do you buy here? Or do you buy here? That's why it's hard to answer your question, JD. This is exactly why it's hard to answer. When it breaks through the moving average, the EMA, I don't know. These are parts of trading plans that individuals have to determine for themselves. Okay, it's the same thing. We don't have to belabor this point. How do you use divergence to trade the Forex market? Let me just ask see if there are any questions. No. Okay. Divergence gives early clues about trend reversals, and it's a good way to see if the trend you are in is losing momentum or not. I use RSI divergence as an early indication of a trend reversal. Divergence on its own is not a good trading signal to trade on. It's in bold. I raise my voice. I want you to understand that it's important, but it's how shall I put this? I don't know. I can't think of a good example. I was going to try to draw a metaphor from the indicators on a dashboard of a vehicle, but I can't think of any good one. You have to handle it with care, okay? It's just a indicator of a certain class that has to be taken with a grain of salt. Well, what can I say? Let's see some of the ways the RSI divergence in Forex trading. Example, divergence with head and shoulders pattern. Both head and shoulders pattern and divergence indicate trend. Let's take a look. Here we go. All right, here we go. This should help us out. Price is rising, and we see a head and shoulders. Shoulder, head, shoulder. It's kind of vague, but you get the idea. Head and shoulders is a classic indicator of a reversal. Why? It goes up, fails. Goes up again. This is the head, the highest point, fails. Tries yet again, fails. That 3 strikes you're out rule very often turns into a downtrend, as it does in this case. So we get a sense that this might be on its way still while it's rising. This sends it down. This drives it up, but not enough to keep the negative divergence from showing up on the screen. And so anywhere, certainly around here, you would have been clear. Time to sell short. Okay. Here it sort of does nothing, very unexciting, doing not much. It's a breakout, and again, you could have seen that perhaps with the severely downward sloping moving average, but what happens after all this? The whole fundamental of this story has changed, and the uptrend reverses into a whole new downtrend. So this is euro dollar. I don't have a date on this. Do I have a date on this? 2020. April. This of course is the it's a 4-hour chart. This is probably when the pandemic starts to hit. Dollar strengthens, euro weakens. That'd be my guess. That's pretty much it. Divergence of volatility. I don't want to get too involved in volatility. We're going to skip over this. This is too much. Bullish and bearish. We don't really need this. Clean up your portfolio. Okay, this is pretty much. We don't need this. This is all the same story told repeatedly over and over. So let's floor up to some questions, ladies and gentlemen, and then we'll bring the session to a close. So feel free, any subject at all. I'm open to questions. Let me remind you that next week we have a session at the same time entitled Commodity Charts and Indicators, where we're going to look specifically at the world of commodities, what their behaviors are, the fundamentals of many commodities, and some indicators that are germane strictly to commodities, principally the commitment of traders report. Let me say furthermore that if you're a member, if you're a regular, here I have a question coming in from Bucharora. How can you detect the smart money involving while reading volume? Well, first of all, you can't. The only and even the term smart money, sir, is a load. Okay, next week when we look at the commitment of traders reports talking about commodities indicators, the smart money, which generally is defined as the large speculators. We've got the small speculators; they're generally wrong. You've got the large hedgers, which are understandably against the trend. If price is rising, they're going to be net short because they're hedging, they're protecting themselves. If they're net buyers and they're buying long, they're going to be short to hedge if the prices are rising, and vice versa. And so even in that, which is probably the closest there is to anything that even tries to define smart money, is wrong way more than it's right. In terms of the volume, all a volume indicator can show us is sometimes those volume symbols will come out red or green. And if it's red, it just means there was more selling than buying. There were more asks than bids. That's all. Ed asks, is the RSI showing divergence of purchases and sales of a stock then? Great show. Glad I tuned in. Ed's a financial analyst and a cost estimator. Wow, Ed, thank you very much. That's a very high compliment coming from you. I appreciate it very much. Yes, yes, it's showing the divergence of purchases and sales of a stock no, I'm sorry. RSI doesn't show the divergence of purchases and sales. It shows the difference in price. It's a different. It's based on price, not on. Unless I could be wrong. Ed, you caught me there. I don't want to give you wrong information. What is let's see what the RSI. I don't think I have a definition of RSI, and I've momentarily forgotten about it. I did not include, of course, the formula. If I had the formula, I could tell you immediately what the RSI is. It slipped my mind, and I don't want to give you incorrect information. The RSI is a momentum indicator. So it does take in volume, which means as long as the price actions in the RSI indicator line up with the same way, we can assume the ongoing trend. So it does take volume into account. So in that case, to get back to your question, sir, now that I understand RSI a little better, it shows the divergence of purchases and sales of a stock then. No, it's just, no, I'm having a problem with your question actually, Ed. I understand what the RSI does, but what it shows only is that the momentum doesn't agree with the price movement. It's divergent. The price movement is moving one way, but the RSI indicator is moving the opposite way. That's a divergence. Okay? Now, Jose asks, should we be very cautious when we encounter an RSI divergence, but the volume is quite low? Oh, yes, of course, Jose. Anytime the volume is low, whatever you're seeing above that volume indicator is less important. And I'll give you the perfect example. When I was, and I recommend this to young or new and aspiring traders. Trading, particularly commodities, but even in that I include the S&P 500, the futures contracts, I should say, most of which are commodities, but some of them are FX and indices. When they trade, I don't know, like 23.25 hours a day. They take like 3/4 an hour a day for maintenance and rest time, but they're open around the clock. The volumes are very low, but there is still some price movement. And as a young trader, you can trade them and make a little money. You have to be very patient. They don't move fast. After a hectic day of trading, most of the traders go home and close up and don't do anything, and so the volumes are low. But there are some people, people trade around the world, and so there's always a little action to be had. But if price rises all night long, it doesn't mean anything. The volumes, unless it's high volume, but there's never any high volume. So those movements during the off hours have no significance from a fundamental point of view, but they are tradable. My pleasure, Ed. Does the momentum come always with volume? Yeah, it does. All the momentum indicators, because volume is momentum is the natural sciences, a natural science term for what we refer to as sentiment, and sentiment is the better term because momentum is by definition misleading. It's misleading in the sense that it's scientific. And remember something, and I point this out fairly often, and I can't really point that out enough. All these charts and graphs and indicators and so I know that some here I can show you on my graph in a moment. Just one moment, please. I will go to a real-time chart. And show you what I'm talking about here. still fooling around with this. Yes, sentiment really means if there's a lot of buying behind an uptrend, there's a lot of strong sentiment behind it. If prices fall, and I so wish I could get this normal, but I can't. Let me go to another chart that might just solve the problem altogether. Okay, not useful particularly. So here's a great example. Price is rising here, right, steeply, but the volume rises the force index rises slowly. And if we could see this, which I just know we can't, one last try, and then that's what I wanted to do. Here it works. There we go. That's what I wanted to do. Why is it so hard? Oh, that's why it's so long, because there was this huge volume spike. That's why I can't see it. All right, that makes sense. I understand that. That screws it all up. So you see, the volume takes this huge spike and stays high, but price is falling. So at this point right here, even price is long since rising here. To raise this, that would be nice. There we go. I can't. Price is rising, but the force index is still in deeply negative territory here. So I hope that answers your question. They're not. Volume plays a huge role in it. Yeah, it's all about the volume. There's not enough volume. There's not enough sentiment, and these indicators lack validity. But here, this is the earnings report, which was stupendous. Rheinmetall, by the way, is one of Europe's largest armaments manufacturers. And well, I'll give you a better picture. Those of you who are unaware of this, traders in the house know that we've been pitching this for months and months. This is Rheinmetall, okay? Where's the outbreak of the war? Right about here, okay? All right, enough said. Rheinmetall up, up, and away, and it's going to continue. Any other questions, ladies and gentlemen? Oh, I'm sorry. I wasn't even showing the graph at the time. My mistake. Forgive me. Here's Rheinmetall. That's what I was talking about. And here's the volume and the force index. I'll go back to the 1 hour chart. I'll show you the point I was making. Right. Here's the volume the price is still going up, and yet force index is still quite negative. It doesn't even get, when it gets positive, it doesn't even get so excitedly positive. Okay, because the volume is low. That's why. Any other questions, ladies and gentlemen? If not, let me say that, oh, there's a bunch of them. Oh, no, here it is. Okay, can't see the chart, says Jay. Okay, I'm sorry, Jay. Again, it's a one screen problem. I'm sorry for that. So, ladies and gentlemen, I'm going to bring the session to a close. It's a little over the time I like to run. Let me say to you that on behalf of the staff and the management here at Alvexo, we're always humbled and very grateful to you for patronizing us as your online broker. And for those of you who have come to us who are not members, clients in the house, and are looking for an online broker, consider opening an account with us. This is the kind of work we do for our people. We're stand-up, straight-shooting, honest brokers. We're not right all the time. We lose plenty of money like everybody else. But we do make more money in the long run than we lose, which is the sine qua non of success in our business. And so my pleasure, Buchera. It was a pleasure having you and having your commentary as well. Thank you, sir. Thank you very much. This is the kind of work we do for our people. And it comes out in ebooks and signals and videos and webinar, all sorts of things. And so please consider opening up an account with us. And with that, ladies and gentlemen, my pleasure, Jose. It's always a pleasure to have you in the room as well and your commentary to boot. So, ladies and gentlemen, I'm going to bring the session to a close. You'll be getting a link to the recording anytime within an hour or so. And I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.